Recall the purpose and participants in the primary markets. The primary market is where securities are sold by the issuer, a corporation, or a government to the investing public in what are known as issuer transactions. The issuer of the securities receives the proceeds generated by the sale of the securities in the primary market. By contrast, the secondary markets are where securities trade between investors. Another term for these markets is capital markets. When you see the terms primary offer or primary market, you know that we are talking about an issuer that is selling a security to raise capital. The sale of securities to the public allows corporations to raise capital relatively quickly to take advantage of changes in the economy. This activity is a key piece of a modern economy, allowing corporations to raise the money needed to build factories, buy equipment, and expand the demand for labor, creating jobs. At the same time, it allows investors, from the wealthiest billionaire to the regular person saving in a 401k, to grow their assets alongside the economy as a whole. The person who owns a mutual fund share that holds a partial share of a corporation earns the same return on a per-share basis as the largest stockholder of that company. A corporation may issue up to the number of shares that are authorized in the corporation's bylaws. Governments use the primary markets to raise money for infrastructure projects such as bridges, roads, dam, ports, etc., as well as to fund other programs for the public good. Take a look at a bridge over a river that ties two cities together and benefits both. Who built that bridge? Well, construction workers built it, engineers designed it, and it was paid for by investors who believed the project was worth supporting and hoped for a return on their investment. Take note, the primary purpose of the Securities Act of 1933 is to require full and fair disclosure in connection with the sale of securities to the public. The Act requires that a new issue, unless specifically exempted from the Act, be registered with the SEC before public sale. All investors must receive a detailed disclosure document known as a prospectus before purchase.
Offerings of securities to the public in the primary market generally come in two types: the initial public offering IPO or an additional public offering IPO. An IPO may be called a follow-on offering or a subsequent public offering. Initial public offering IPO. The first time an issuer distributes securities to the public, it is called an initial public offering IPO. Any subsequent offerings are known as APOs. Example: first time that ABC Shoe Co. issued shares to the public, it engaged in an IPO. Let's assume ABC Shoe received the entire proceeds from that initial offering. 4 years later, ABC Shoe raised additional capital through a follow-on offering in which it also received all the proceeds. Both offerings are primary because only the issuer is receiving proceeds, and both the IPO and the follow-on IPO shares must go through a registration process with the SEC. Additional public offerings APOs, follow-on offerings. As mentioned earlier, a corporation may offer additional shares of stock to the public as a primary market transaction. These follow-on offerings go by several names: additional public offerings APOs, subsequent public offerings, or follow-on offerings. Sometimes, the word primary is used instead of public: additional primary offering or subsequent primary offering. There may be multiple APOs over time. The two defining characteristics are that these are primary offerings, the proceeds go to the issuer, and they come after the IPO. This class of shares is already available to the public. In the next section, we will discuss the participants in the primary market and their respective roles. Take note: in securities, the term person refers to a natural person, human being, or a legal entity such as a corporation or a government. Any entity that can legally enter into a contract is a person. Issuers of securities can be corporations, municipalities, and the federal government or its agencies. Corporations may issue both equities stocks and debt issues bonds. Larger corporation stocks that, after being issued, trade on a national exchange listed or the NASDAQ system are called National Market System and MS securities. Stocks that will not be listed are NONG and MS securities. More detail on these parts of the secondary market are covered later in this unit.
Municipalities, municipal governments issue municipal bonds and other types of debt. As a reminder, municipalities are governments at the state or lower level, such as counties and cities. This debt is sometimes called munis. The federal government and agencies, the largest issuer of debt in the United States, is the Treasury Department. Debt issued by the government is sometimes called govies. A small number of agencies of the federal government also issue debt. Agency debt is covered in the Debt Securities Unit.
Underwriters, broker-dealers, investment bankers. An underwriter is a type of broker-dealer BD, also called an investment banker, that works with an issuer to bring its securities to the market and sell them to the investing public. Investment bankers help the issuer to structure new issues and, at times, form syndicates with other underwriters to facilitate this capital-raising process. Syndicates are explained in more detail later in this section. Underwriting commitments. Different types of underwriting agreements require different levels of commitment from the underwriters. This results in different levels of risk for the underwriters and the issuer. Best efforts underwriting. Investment banker acting as agent. A best efforts underwriting calls for the underwriters or the syndicate to sell securities from the issuer to the investor, acting simply as an agent. This means that the underwriters are not committed to purchasing the shares themselves and are therefore not at risk. Best efforts deals are closed by collecting client funds into an escrow account, so no underwriter capital is at risk in this type of offering. The underwriter is acting as an agent contingent on the underwriter's ability to sell shares in either a public offering or a private placement. The underwriter is not at risk for the shares, but the issuer is. If enough of the shares cannot be sold, the issuer will not raise the needed capital. There are two types of best efforts underwritings to be familiar with: all or none AON. In an AON underwriting, the issuing corporation has determined that it wants an agreement outlining that the underwriter must either sell all the shares or cancel the underwriting. Because of the uncertainty of the outcome of an AON offering, any funds collected from investors during the offering period must be held in escrow pending final disposition of the underwriting. Mini-max. A mini-max underwriting sets a minimum amount the issuer needs to raise to move forward with the underwriting, as well as a maximum amount of securities the issuer is willing to sell. The underwriter must locate enough interested buyers to support the minimum floor issuance requirement. Once the minimum is met, the underwriter can expand the offering up to the maximum ceiling amount of shares the issuer specified. Firm commitment underwriting. Investment banker acting as principal. Firm commitment underwriting is a widely used type of underwriting contract. Under its terms, the underwriters contract with the issuer to buy the securities. The underwriters buy shares from the issuer, resell the securities to the public at a higher price, the public offering price pop, and earn this price differential spread for their efforts. Here, the underwriters are acting as principals rather than agents. They are committing to purchasing any unsold shares for the syndicate account. In this type of underwriting, it is the underwriters, not the issuer, who are at risk for any shares they cannot sell to the public. If the shares cannot be sold, the underwriters must place the securities into their inventory and run the risk of losing money if the position falls in value. The issuer knows that all the capital needed will be raised because the underwriters purchased the entire issue. Please note that a firm may never guarantee to a customer that it will repurchase the shares at the pop if the deal subsequently trades lower. Syndicates and large firm commitment underwritings. It is common for a group of BDs to form a syndicate. A syndicate is a type of joint venture where the BDs share both the risk and the profits from the offering. One of the members of the syndicate will act as the managing underwriter, taking on a lead role and providing significant resources to the venture. Often syndicates will bring in other BDs to assist the syndicate in the sale of the securities. This is the selling group. The members of the selling group do not commit capital, nor do they hold the securities in inventory the way a syndicate member does. Selling group members take on no liability for unsold shares.
Investors in the primary market are those who are purchasing the new issue and intending to hold the security for a period of time. They may be divided into three groups: institutional, retail, and accredited. Institutional investors. An institutional investor is an entity that pools money to purchase securities and other investment assets. Institutional investors can include banks, insurance companies, employee benefit plans like pensions, hedge funds, investment advisors, and mutual funds. Some institutional investors are called qualified institutional buyers (QIBs). This generally means that the QIB owns and invests a minimum of $100 million in securities on a discretionary basis. Retail investors. The typical retail investor is investing their own assets. Any investor that does not qualify as an institution should be treated as a retail investor. Though these investors may be quite large, most are smaller investors. As they tend to be less knowledgeable than institutional investors, sales to retail investors have higher communication and disclosure expectations. Accredited investors. Accredited investors are a subset of investors made up of all institutional investors and certain retail investors. The following are retail investors who qualify as accredited investors: insiders of the securities issuer officers, board members, major stockholders, those who meet certain financial criteria, an income of at least $200,000 or more the past 2 years and are expected to meet that criteria in the current year. If the purchase is in a joint account, this number is increased to $300,000. Or have a net worth of $1 million or more, not including equity in the primary residence. Natural persons qualified based on certain professional certifications, designations, or credentials or other credentials issued by an accredited educational institution. Holders in good standing of the Series 7, Series 65, and Series 80 to licenses as qualifying natural persons. The Securities and Exchange Commission (SEC) has the flexibility to reevaluate or add certifications, designations, or credentials in the future. Note that the investor must meet at least one of the listed criteria to be an accredited investor. They may meet more than one but do not have to. The assumption is that the accredited investor will have a higher sophistication level than the average retail investor and will not need the same level of protection. These qualifications appear in Rule 501 of Regulation D of the Securities Act of 1933. Take note, retail and institutional investors are active participants in the secondary markets, but the designation of accredited investor is used exclusively in primary market transactions.
Municipal advisors. Municipal advisors are a type of investment banker that advise municipalities on the issuing of municipal debt and other types of municipal securities. Municipal advisors work under a contract with the municipality to provide advice on issues such as debt structure, bond features, and other issues involved with raising capital. Municipal advisors may assist in some of the underwriting functions, such as preparing the official notice, but they may not be compensated as part of the underwriting sale of any issue they provide advice on. In other words, they may not switch roles from advisor to underwriter.